Welcome to Barchart's weekly series of webinars designed to help you, the investor trader, better understand a variety of trading ideas and concepts, as well as the pages and tools Barchart provides to help you make a more informed investment decision. Today's subject, an analytical look at stochastics and relative strength index. Now, relative strength index and stochastics are two of the three more commonly used price momentum oscillators, MACDs being the third. And they quantify price momentum, in terms of overbought and oversold to help traders confirm or warn of changes in price trends. But I believe that today's traders use these indicators incorrectly and to generate signals without taking into consideration these underlying trends. Hello, everyone. My name is John Rowland, and today, hopefully, I will give you a better understanding of the math behind these two popular indicators. And we'll look at the proper techniques to use them and some common interpretations. Plus, I'll apply them to some more widely traded assets and show you some pitfalls to avoid while using the secondary analysis in helping us determine risk of a trade, timing, and with our trend analysis. Okay. With me today, as always, is my partner and our moderator, Jean Baker. Hello, Jean.
Good afternoon, John. Hello, everybody out there.
Jean, you sound like you're a little under the weather.
Do I? I'm doing just fine, John. Thank you.
Okay. Well, we'll try to keep it. We won't pick on you today. We'll get you.
No picking on me today. Okay.
So let's get started then.
Okay, let's go.
Just remember that all trading involves risk and that today's session is for educational purposes only and should not be construed as an endorsement to purchase or sell a particular asset. And that we at Barchart advise you to seek the advice of a qualified professional advisor to consult you if you are in light of your financial conditions and ability to bear risk, and that also that past performance is not indicative of future results. All right. So what is the importance of technical indicators? Well, all technical indicators can help play a role in our price and trend analysis, right? Helping us to confirm trends, warn us of changes in momentum, and alert us of potential price risks. Some indicators, for instance, stochastics and relative strength index, or RSI, are helpful in determining price momentum and trend momentum, right? But they don't predict prices, all right? And an important fact about technical analysis is that it's inherently flawed because the data that we're looking at or the data that is collected is derived from the past. And many traders, I believe, put too much emphasis on these lagging indicators to predict future prices. So the flaw being, it's like driving down the road, looking in your rearview mirror and assuming that the road is straight before you, it's going to be straight moving ahead, right? It's kind of flawed in that sense. And indicators are really better served as support information roles. In other words, enhancements are to help us identify potential changes in market momentum, right? They're not for predicting, but for confirming the price actions of our trend analysis, what the trends we're looking at and what is going on with price. All right, relative strength index. Now, this is different from another analysis that you might have heard of or referred to as relative strength. That is common with equities markets. For instance, you might look at a stock or a sector or an industry, and for instance, let's say technology, and those stocks are outperforming the broader market. That is a relative strength analysis. That's not what we're talking about. What we're talking about here is we're going to index price. We're going to turn price into another number in terms of our momentum. So it was created by Wells Wilder, the godfather of technical analysis, and it helps calculate speed or momentum of the recent price changes of a stock or a security or a futures contract to determine if that price is overbought or oversold. So I want you to think about RSIs in terms of like the speedometer in your car. It measures the rate of change or the speed of our trend, right? As we put more gas on the pedal, right, the faster the car goes. As our price increases in an uptrend, as price is appreciating, so does our RSI, right? But at some point, no matter how much gas I put on the gas pedal, right, the car won't go any faster, right? It will still be going at an extreme rate, right? It's still going fast, but it's not the rate of change or the acceleration has slowed down, right? In other words, we're letting up on the gas a little bit. We're still going fast down the highway, but we're just letting off the gas. What we want to learn how to do is to identify when we take our foot off the gas and when that change of speed is going to affect our trend, okay? All right, so RSI converts momentum or the speed of our price into a number. And this is a bounded range, right? And overbought conditions would be found when the RSI is above 70, and an oversold condition could occur when it's below 30, right? Again, it's just telling us that price is in this particular range of this bounded range of where we would find over a period of time, okay? And that period of time typically is 14 days. So what RSI does, it calculates this gain or loss over that set period of time and looks at it in terms of ratio of up days versus down days. And it also gives a greater importance to the more recent price movements. Now, inside of Barchart, for those of you who are into the math part of all these indicators, under the tools section, there is a technical indicators library, resource library. And if you go there, you can see here it says relative strength index, and you could open that up. And here would be, basically the common interpretations, but also that math that is behind how an RSI is created. All right. So what are some of our more common interpretations? Well, if the RSI is above 50, that midpoint of our oscillators range, 0 to 100, the underlying trend is usually an uptrend. And conversely, if it's below 50, we're probably in a downtrend. Again, it's important for us to understand this because you will find moments where your RSI will be falling, but you're still in an uptrend, right? Think of it again in terms of our car, right? We're on the highway, we're accelerating, we're getting up to cruising speed, right? And then we turn on the cruise control. What do? We're still giving the car gas, but that rate of change or that momentum has changed, but we're still going down the highway as long as we're following the speed limit at whatever, 70, 75 miles an hour, right? But also I want you to think about this in terms of how it was created, right? It's a number of up days versus a number of down days. And so as long as I have an RSI above 50, it's telling me that there is maybe just one more up day than there were down days, right? And if that one up day could be just enough to put me in an uptrend, okay? Now, divergence can be applied with RSIs, and what divergence says is that If price action is moving in the opposite direction of our RSI, this is called negative divergence. And this could possibly warn us of changes in price, changes in trends. And divergence is the most common interpretation used by traders. But I believe that most of them abuse this divergence, right? Another interpretation is something called positive convergence, right? When price and RSI are both moving in the same direction, right? Price initially outpaces the RSI. Think again of our car, right? This is where, if I'm in the beginning of an uptrend, this is where we're starting to give gas to the car, right? Our speed is not there yet, right? We're adding more gas, right? We're increasing the acceleration, right? The car is starting to move faster and faster and faster, right? They're both moving in the same direction, right? And this is usually typically associated with a strengthening trend. And a less common use of RSIs, and also when we look at stochastics, is something called failure swings. Now, a failure swing occurs when our oscillator indicates an overbought or sold condition, and then comes out of there. It corrects. And then it reverses and trends back towards overbought or oversold levels, right? But it fails to achieve overbought or oversold, or it even fails to achieve the previous peak of overbought or oversold, and then falls back, right? Or returns back beyond the correction, right? This is a signal of a greater confidence that you have a significant trend change. Typically, what we call this is a kind of a breakout scenarios, right? And to my opinion, right, I think this is the most interpretive way to use, most effective interpretation to use RSI, right? Think about this in terms of a true trend analysis, right? What is an uptrend? An uptrend is a series of higher highs and higher lows, right? And a downtrend is a series of lower highs and lower lows. What a failure swing does is it helps us to confirm that higher high, and that higher high for an uptrend, or that lower low for a downtrend, all right? So let me give you a kind of a quick example of this, and then we'll come back to this slide a little bit later. Excuse me, this example a little bit later. So this is the ES, the futures contract, S&P 500. And here, what I'm talking about, here we can see that our RSI has fallen, our RSI has fallen into an oversold position, and then it comes out. And then the RSI comes back, but fails to get down to that previous swing low, and then moves away, right? In other words, once price gets back above here, now this RSI is acting like a trend. It's making a series of what? Higher lows and higher highs. This would be a confirmation right in here that our price action that we see here is now beginning of a trend. Again, patience in trend analysis is important in our execution of our RSIs. Here we see a failure swing exit. I have a uptrend, right? I'm with the trend, and here you can see we get an overbought scenario, right? The RSI falls out of the overbought scenario, fails to get back in, right? Fails to swing back up, and then breaks down, right? A series of lower highs and lower lows, again, a downtrend. And this right here, this area right here, would be the signal if I had long position that would say, hey, there is a potential of this trend to reverse or this price action to reverse. And that would give me permission to manage my risk, not necessarily to take a short position, but to, in this case, to manage my risk to exit a trade, right? So we'll come back and look at this example in a second, okay? All right, whoops. Let me do this first. Let me get rid of that. And we'll go back to our slides. Okay. All right, stochastics. All right, created by Dr. George Lane. And what does stochastics tell us? Well, it really just measures the price of a stock or a security in a relationship to a range of high and low prices over a period of time. Again, typically 14 days, right? So let me give you an example of that. So really all stochastics is telling us is telling us where is price in this range over the last 14 days, right? So this box here, this pink box represents 14 days. There's 14 candles inside of this box, right? What is the range of price as we look at the last candle in this box? Well, this last candle here, you can see is, somewheres, I would say, halfway in this range of price over these last 14 days candles. But as I move my box forward, right, notice my stochastics here, right, is rising because my price is getting closer to the extreme edge of that range over the last 14 days. That's all stochastics is telling us. Where is price in the last 14 days as it relates to today? And when it gets into the high end of that range, the stochastic tells us we're in what is called the overbought scenario, or if it's in the low end of that range, we're in the oversold scenario. So Lane believed that when the oscillator, this stochastic oscillator, follows speed and momentum, and that when there's a change, right, a change in that momentum, that could precede a change in the price of our stock, right? That concept of speed and momentum, right? So there are two types of stochastic oscillators. There is one that's called a fast, and that one is a line comparison between what is called a 14-day period raw stochastics, or K percentage K, and then a 3-day moving average of that raw, and we create something called the fast percentage D. A slow stochastic is a line comparison of the percentage D, the moving average of that raw, right? And then another moving average of that, a 3-day moving average of the percent D. In other words, a moving average of a moving average. So it's a little bit more slow, it's a little bit more smoothing, right? The overall difference between these two is that the fast is a lot more sensitive to current price, where the slow is a little bit more static to current price. Most traders will use the slow and not the fast because they find that it tends to be oversensitive and give too many false signals. And again, inside of our website, under the tools section, under our resources, technical indicators, there is, that math, if that's something that you're interested in, the fast and slow. And again, down here, you will find that math that shows you how they perform that indicator, okay? All right, so what are some common interpretations for stochastics? Well, there are two really common ones. First of all is, again, this concept of overbought and oversold. Again, what we've just learned in that pink box is an overbought is just telling us that price is in that upper range over the last 14, and oversold it's just in the lower range. And it quantifies it in terms of above 80% or below 20%, right? And again, divergence is a popular use when it comes to stochastics. When our percentage D value fails to confirm a price movement, right? In other words, our price is making a series of highs, but our stochastic is now making a series of lower highs, right? This is a divergence for us. And typically this is a sign that our momentum is changing. Remember, think about this in terms of our car, right? I'm going down the highway, I'm taking my foot off a little bit of the gas, I'm getting into cruise control, I'm in the upper range of the last 14 days. Doesn't mean my trend is going to change. It just means that my momentum is slowing down, right? But I'm still traveling down the highway at a high rate of speed. I'm still in a potential uptrend. What we want to look for is when we take our foot off the gas. Now, I will tell you that from years of experience that in strong trends, typically the first divergence that corresponds with a price action is typically a false signal. It's just kind of the way it is. And here, this is where we're going to use that extended classical chart pattern analysis to help us. Again, we want to make sure that our stochastic is confirming that second higher high or that second lower low. That's what we want to use them for, not to give us a signal, say, hey, I'm overbought, this is a sell signal, or I'm oversold, this is a buy signal. Many traders will use stochastics in terms of what is called a crossover. We'll look for when the fast and slow change course opposite of each other. In other words, the fast crosses over the slow. But again, I believe this gives a lot of false signals. What we want to look for is crossovers with positive convergence, right? In other words, looking for price action that confirms what we're seeing, and then the oscillator both going in the same direction, all right? All right, so what are some of the benefits of using RSI and some of the caveats of using RSI and stochastics? Well, again, this term of overbought and oversold are just indications that our oscillator has reached those extremes of that bounded area, right? To use to measure our price strength or our price weakness, right? And, you know, overbought is just a term, right? That's really all it is. It could signal to us that our bull market or our uptrend is weakening, or oversold could tell us that our bear market or our bear is potentially dying. It's not an indication of potential market direction, right? It's just telling us that our range of price is catching up with it, right? And that the momentum is slowing down. And it's not an endorsement for a trade entry or exit, but it does give us permission to manage risk. And this is the key difference. And this is where I believe a lot of traders abuse it. They use it to give them a signal for a buy or sell entry without taking in consideration the risk of their former trend or the trend that is in control. So if I'm in a range-bound market, right, and I'm looking at a range-bound market, then these overbought and oversold signals tend to be a little bit more effective, right? In terms of telling me that, hey, price has gotten high on the range of this bounded market, or it's getting low in the range, and that there could be a reversal in price. If I'm looking at trending markets, especially strong trending markets, then the overbought and oversold scenarios aren't as effective, right? I want to use RSIs and stochastics to better serve me in terms of warnings of potential trend changes. Again, that change in momentum, and then that confirmation of that new higher high or lower lower, right? We're going to use them to confirm a trend change, not predict it, right? Because oscillators, because they're lagging, remember, will remain in an overbought or oversold condition for longer periods of time in strong trends. And many breakouts or crossovers will give false signals. So both of these, RSIs and stochastics, work better, in my opinion, as a supportive indicator, right? In other words, to enhance or confirm our price movements, right? I'd rather use them to improve my odds of a trend that is in control than to look for them to as a contra trend indicator, right? When it comes to trend analysis. And the other thing that I do believe in is that I'm not going to use them as a standalone, right? I don't want to contradict other references that you might have, right? Again, this is from my own personal experience. I'm going to use them with other forms of trend analysis, and I'm just going to use them to help me confirm or enhance one of my analysis, right? I'm not going to use them as a catch-all or standalone. All right, so enough with definitions and textbook stuff, all right? Let's get right to the markets, okay? All right, so let me go to, just a common market. Here's the Dow. And, before I start, though, let me just point out here that under the technical section here, there is something called technical analysis, right? We can click on that page, and inside of there, you will find, right, a number of period days, right, time periods, and you do see our ROS, our stochastics, our percentage K, and our percent D, and also you have your relative strength index. Again, this is just a quick reference for you. And there's other technical tools in here that you can use. All right, so here I'm in the Dow. Let me blow this up a little bit so it's a little bit better to see. And what are we looking at here? Well, okay, so let me kind of get this going here. All right, so in the middle here, these candlesticks, this is actually the Dow, right? The Dow Industrials, right? And above here, we have our stochastics. And notice here, up here, it says stochastics 14, 3, and 3. So we know that this is a 14 raw, 3-day moving average, 3-day moving average. So this is the slow stochastics. Again, remember, we can find any study, right, on our study buddy button up here. And if I scroll down here, I can find stochastics and RSIs, or, if I know exactly what I'm looking for, I could just type it in the search. Now, notice that it says the current studies that I'm using are the stochastics 14, 3, and 3, the slow, and my 14-day RSI. Now, down here is my RSI, and then you can see over there 14-day RSI. Now, also, I know some of you are probably say, well, how come you have your stochastics on the top and your RSI on the bottom? Now, not any reason why I do this, but I will show you that you can move your studies around to make fit your chart better. So all you do is come into the right-hand quarter here, and I've just move this around. I can move it up or down, and I can stack them according to how I want to look at it if I'm looking at multiple studies, all right? Okay. That's just a little chart 101 for some of you. Okay. All right, so what do we see here? So we see the Dow is in a range bound, right? We can see it's kind of just floating around in this range. It's kind of bouncing back and forth, right? And our stochastic here, you can see that as price is going up, right, it's getting into what is called an overbought signal. Now, this not necessarily means that price is going to go down. It just means that right now, this price action, if we think about it in terms of those 14 days, this price action is in the high end of the range over the last 14 days. That's all it's telling us. What we want to look for is when we get that positive conversions, right? When the stochastic or the RSI are moving in the same direction as our price. That would give you the potential sell signal, or it's telling you in this case, right, that price has gone to the extreme or at the far end of its bounded area, and that there could be what we call a reversion, or the price could move back to, somewhere in the middle of this range. Again, price goes down. All this is telling us, the stochastic is telling us, that this price action right here is in the low end of that range of the last 14 days. But in this bounded ranged market, it's also telling us that right now we're at the extreme of this range. This could be a potential buy signal. Again, I'm not going to take this trade just because I have an oversold signal. I'm still going to wait for that price confirmation, right? A green candle or a new higher high, and I'm going to look for that confirmation, that positive convergence, as my RSIs and my stochastics both turn up, right? So there's a little bit of how we're going to use RSIs and stochastics, right? Range bound, just telling us we're at the extreme ends of the range. When I get an overbought or oversold signal, I still need to use price data to figure out if that's what I want to do, that trade I want to do. Okay. Let me go to another market. No, not Amazon, not Amazon, John, Amazon. All right. All right, so let me blow this up again so you guys can see this, right?
Hey, John, and when you say blow the chart up, can you do a back go back to your chart and show them exactly where you are doing that?
Yeah, there's a little button right here, a little arrow button, and what this does is the technical term is it goes to a dashboard. Is that right, Gene?
No, it's what we call a pop-out chart. It pops
a pop-out chart. There you go.
Pops your chart out into a full screen browser window.
Yeah, okay, it's great. Really nice. It's really nice, right? Because it's a lot bigger and you can see a lot more information, right? It's not confined to that small area. And this is kind of how I do my analysis anyways. All right, so here's Amazon again. Let me kind of just tighten up this time frame a little bit, right? And again, a range-bound market, right? A range-bound market. Where did we see price at the extreme of that range? Okay, right here and right there, right? And did we get a overbought or an oversold signal? Yes, we do. We still need that positive convergence to give us that sell signal or that buy signal. Notice that we had multiple overbought and oversold signals in this range-bound market, but the price was not at the extremes of this range. Again, false signals, right? There's not a lot of juice in these particular trades, right? We want to wait for those extremes, okay? Now, moving forward, right? Here we got that oversold signal. Again, we want to wait for that positive convergence, right? That positive convergence where our price action, right? Here's our little mini downtrend where we stopped making lower lows and started to make higher highs, right? So you would have gotten a positive conversions, but we still might need price action to get above one of these set of recent highs to give us that entry that we'd be looking for, right? Again, over here, this is what we kind of want to look for, is where we get the oversold scenario, right? An oversold, right? But I'm already in an established uptrend, right? That's where I want to kind of use these for. I'm not looking at these for contra trend indicators. I'm looking for them to give me an indication that my trend is about to get in control again, or that price is about to move ahead, right? So again, we could talk about positive and negative conversions, right? So maybe up here, some of you would say, oh, well, you've got negative conversions, but notice what is happening. Yeah, our market is still showing me a uptrend. And if we look at my RSI, right, again, we're making new highs in our price action, and we're making new highs in our RSI. So this is still a positive reaction to price action. But in here, we do see price starts to fall, right? And then price, our RSI, is telling us that we're taking the foot off the gas, and we're starting to pick up some momentum actually to the downside. But what's my trend? My trend is still up, right? My trend is still up. I'm not giving myself permission to take a short. I might give myself permission to take a little profit off the table, right? Now, what did we see? We see an impulse correction here, and price has returned to where the origin of this last breakup. That is typical trend analysis. That would be an opportunity for us to come back in the market. But our RSI and stochastics aren't in the oversold scenario. So it's not confirming that to us. So we would be on our own. We wouldn't be using these two oscillators. If these had fallen into an oversold scenario and price had come into an area where I believe that it was going to hold, then that would give me permission to come back into this trend. Now, at this point, we're kind of in limbo here, right? We're not oversold, right? We're not overbought, and our price action has found a temporary support level, but there's no guarantee that it's going to go back up or that it's going to go back down. We're going to have to wait until something else happens. We're going to have to watch this market over the next few days. Obviously, I think if I could find an entry opportunity, now it could be down here in this circle, right, as my trend re-engages the price, right? And if I got an oversold scenario in my RSI and my stochastics, that would be an enhancement to the trend that I'm already seeing. All right. All right, just checking my notes here. Jean, are there any questions that are popping up that are common questions?
Well, I've passed a number of them on to you, John. If you want to take a quick look at them, and maybe while you do so, I'll talk to everybody out there about Barchart's membership options. What John is demonstrating to you today, being able to put studies on a chart, being able to draw, put your annotations, draw ellipses and trend lines, those are all part of a free membership. All you have to do is you sign up with your email address, and every time you visit a chart, you can put studies on. We'll remember the chart for the next time you come back to it. So, there's absolutely every single reason to sign up for a Barchart account if you already don't have one. We also have a Premier membership that gives you a whole lot more. There's all sorts of screening capabilities and things. Again, John's not really pointing out anything that is part of a Premier membership per se today, but you do have all sorts of other benefits attached to a Premier membership that you can take advantage of. So if you're not a member, join, try us out. Okay, John.
Yeah, for sure, right? Exactly. I think there's a lot of more benefits from becoming a Premier member, especially when you get a lot of these extra tools that you can use. All right, so let me see. My chart is, here we go. All right, so here's a couple questions that I want to answer before I go on to the next one. So Stu asks, are there any predictive indicators. So Stu, again, all technical analysis is based on past information, and so there really aren't any true predictors. I do believe that there are predictors in terms of price analysis and basic trend analysis, and I do think that there is one that can predict, and that is volume. I really believe volume is one of the true technical analysis tools that we have that's in real time and not in past data. So you can look at volume as prices being created to give you maybe a predictive value. I see a question here about Andrew was asking about traders' abuse of negative divergence. And so Andrew, stick with me, we'll get into that. Dorian asks, is that the signal is derived from the past, and how many days in the past do you look at today? Again, the signal, the math is based on past, right? We're looking at the price action of today, Dorian, right? So I'm not looking in the past, I'm just using the past to kind of figure out what's going on today. Is there been a change in momentum? Has there been a change in that acceleration of price? And is there a change in my trend? If not, right, then these aren't going to help me. They're just maybe going to enhance a trade that I want to find, all right? So Wayne asks a really good question. Wayne says, have you ever found that RSI or Stokes leads the other with some consistency for a particular stock? So Wayne, I'm going to show you an example. I do believe, and I mean, it's pretty obvious that RSI does tend to lead stochastic. Now think about a slow stochastic as a moving average of a moving average, right? So it's kind of more smooth, it's more static. So that makes more sense. And I will show you an example of that, all right? All right, Jane, again, asked what the 1433 means. 14 days, 3-day moving average, 3-day moving average. So look into the slow stochastics in the reference in our technical indicators section of the website to go into the math, all right? Okay, Brian, yeah, MACDs, we're gonna do a MACD one just on MACDs sometime in the future. So yeah, I do believe the MACDs do have an advantage over stochastics, okay? I kind of use MACDs and RSIs together sometimes. All right, so that's most of the questions that are up there. Okay, so I'm in NASDAQ. Let me get my head back into the game here. All right, so here's where we're gonna use, actually, so this is what I'm talking about. Remember our box here, right? That strong trend, that long period of time. Notice that as I move my box forward, right, what is happening to my stochastic? It's getting into that overbought scenario, right? It's not telling me the market's going to go down. It's just telling me that price now is, every time price advances, it's staying in that upper area of the last 14 days, right? It's just telling me we're in the extreme of that bounded. So this is what we call pinned down, right? The stochastic stays high in that overbought scenario for longer periods of time, right? We're going to wait for that breakdown or that price confirmation. In other words, that positive convergence, or if price breaks down from this trend. Now, if I drew a static trend line, some of you would say, yeah, that's trend line has been broken. But in terms of trend, are we in beginning a downtrend? No, we're not yet, right? Because we have yet to make a secondary lower low, right? Are we still in an uptrend? I would say, yeah, we're still in an uptrend, right? We made a higher low and we made a higher high, and now it looks like we've just made a higher low, right? So again, we're kind of in limbo here. We don't know which way our market is going to go. If I'm in an uptrend, I'm going to make a new higher high, right? If I wanted to look to re-engage this trend, again, I'd probably want to wait for a buying opportunity in the oversold scenario. If I'm looking for a selling opportunity, well, now I'm going to wait for that next lower low, and I want to see what my stochastics and RSIs are telling me. At this point, I'm really kind of, again, stuck in limbo, right? Now, we do see here, this is an example of negative divergence, right? Our price is going up and is making higher highs, right? Price is going up, but our RSI is not making the same higher highs. It's actually making lower highs. So this is a divergence. This is an indication to us that there is a slowing or a changing momentum to this trend, that the trend is not as explosive or as strong as it was when it started. So that could be a signal for me, if I am long this market, that I could use some risk management tools to either tighten up my stops or give myself permission to take a little bit of money off the table. Again, once price broke down, not price, my RSI broke from overbought to back into that range, right here, right? That would have been right on that candle, that red candle. And if you were in my candlestick session last week, that is an engulfing candle, and that is a bearish sign. So that would have been an indication to you, another form of trend analysis or price analysis, and then RSI here is now confirming that, right? So that's what we want to use it for, right? A confirmation, not as a predictor. Okay. All right, so I see a question is, how do traders abuse negative diversions? I think a lot of them will see a negative divergence and they'll just immediately jump in and sell the market without understanding their trend, right? And they're going to take a short position. A lot of traders might have come in here and taken a short position, and what is happening to the market? Market's coming right back at them again. So again, I think that negative divergence is a warning sign, but I still need to have that confirmation in terms of trend analysis, right? All right, ES, let's go to the ES. Or did I have it up here? Oh yeah, I did already. Oh, let's go to this one. It's already going to be loading up. All right. Okay, so this is where I want to really show you how to use that proper execution of RSI and stochastics. All right, and I'm going to also talk about another interpretation of how to use stochastics and RSIs. All right, so here's our S&P futures contract. And this is really what we want to do. We want to use RSI and stochastics to find entries that are with our trends, not contra trend entries, right? I could find exits, right, that could be contra trend, but I'm not going to use them as potential entries. So again, this is that example of that failure swing, and this would be an entry, right? Our price has been in an uptrend. This is our correction. The market corrected into an oversold scenario. There is where we get into oversold. Now price, the RSI comes back out of oversold, fails to go back into oversold, and then breaks out, right? A trend formation in the RSI right here would be that confirmation that you are seeing a new uptrend. And there you can see that from this point on, this green candle, once it got above these recent highs, that was the beginning of this next trend. Did it give us another entry? Yeah, it did. It gave us another opportunity to re-engage this trend. And again, just from Monday, again, we are in now getting a crossover, but here we're not getting that positive conversions yet, right? We're not getting it in the stochastics. The RSI is giving us a positive conversion. So I think it was Wayne was asking about which one tends to be a leading indicator. You can see here, RSI definitely leads in terms of our stochastics, right? Now, some of you who'll pick up right away, you'll see that these bottoms in the stochastics and the RSIs aren't in the technical oversold, right? That 20 and 30 regions, right? So there is something called trend ID. Once you have established a trend or you have identified a strong trend, in this case, this is a strong trend, a lot of RSIs and stochastic traders will shift the over and bought scenario. So in other words, in an uptrend, they will shift it forward. So oversold would fall below 50 or around 40, and overbought would be above 80 or in the 90 category for stochastics. If we were going to look at a downtrend, that ID shift would go from like 50 down to 40 to down to 10. So that would be that 40-10. What this does is it does give you some better signals that are outside of the standard range bound scenarios of overbought and oversells. But again, the key to this one is identifying a very strong trend, and certainly we have a strong trend here. So proper execution is looking for entries that are with the trend. Now here we did see that swing failure, that negative divergence, right? And this would give me permission to look for an exit, or in other words, to tighten my stop. And again, for those of you who were in my candlestick class session last week, what do we see here? Well, there's your 3-candle drop, a very rare candle formation. There's actually a bottoming scenario, which kind of tells us that if price gets back above this high, we're going to rip a lot higher, but we haven't gotten back above that second and first candle. So those of you who are interested in this candlestick formation, last week's scenario, we were talking about this one, and it was one of the latter ones that we talked about. Okay. All right. Let's go to crude oil. It's been in the markets. It's been in the news recently. And two things I want to show you here. First of all, again, this importance of using trend analysis or chart patterns as our primary, right? And that using our stochastics and our RSIs as a secondary, a confirmation, right? And looking for buying opportunities in oversold in the strong upper trends, or looking for selling opportunities overbought in downtrend scenarios, okay? So there is a couple examples of that, right? What we've going on just recently, right? The market fell, crude oil fell, what it was about $5 on Monday, right? Most folks would be saying, oh, the sky is falling, let's sell crude oil. But, you know, we got into an oversold scenario in both of our indicators, and we re-engaged our trend, right? Our stronger trend. So that would have been an opportunity for you to get back into this market. Now, one of the other things that I said to you is that in these stronger trends, that a lot of times that first signal is a false signal. And you can see that here, that the first signal out, right, this one here and this one out here, where our market is still going in an uptrend, right? It's not until in the RSI, it's not until the third signal that we actually got that negative divergence and that positive convergence in our RSI, right? Again, here we have a market came back, looked like it wanted to go outside of overbought, and here's where that overuse of negative diversions by traders. Again, I still want to see something happen in price before I go and look at my RSI or my stochastics to confirm what I'm seeing in price. Now, here we did see price broke this low, right? Again, there's that failed swing where we failed to get back above, and that would have been, down around here would have been, if that was your sell signal, would have been an opportunity to get out or to enter a short position. But again, I would not enter this as a short position because my trend is still, looks to me still intact. Now, again, if I drew a static trend line right here, yeah, that trend, part of that trend line is probably over, and I still need, you know, another new high, but we are just still making a series of what? Higher highs and higher lows. We're still in an uptrend, and you can see that the market responded very quickly in a short period of time based on trend analysis and the confirmation that came from our RSI and our stochastics, okay? That negative swing, that confirmation of a higher high or a lower low to give me permission to go long or short. All right. All right, and the final one, because I am coming up on the top of the hour that I wanted to go over, is gold. And I think I did the December contract. Yep. Okay, cool. All right, so Wayne, there you go. There is our RSI is our leading indicator, right? It gave us an oversold scenario while the price is still falling, right? But here, again, we want to wait for that positive confirmation, right? That positive conversions when they're both turning to the upside, right? If I looked at this price action in this box here, right? I'm kind of in a sideways action after a downtrend or maybe a correction. Where do I believe that this price action is going to go higher? Well, I'm probably got to get above these highs right here. Where do we get above these highs? On this candle here, this candle, right? This candle. What is my RSI doing? It's giving me a positive reading, right? It's telling me that we're putting gas on the pedal. The car is starting to speed up, and our stochastics, right? Positive, right? Positive, right? Positive. We've gotten back above that, those highs, and now, right? It's telling me my car is revving, or that the momentum is in that forward or uptrend scenario, right? So using that as an confirmation, right? Being patient and using it as a confirmation. All right. Okay, cool. Right at the top of the hour. Let me just double check there are any other questions.
Yeah, and
Andrew
just
asked, go ahead.
no, go ahead, Jen.
No, Andrew asks, how do you deal with conflicting signals between two different time frames? It's a great question, Andrew. So yeah, typically when you're looking at lower time frames, you're going to get a lot more sensitivity to current price. So Andrew, I'm a real believer in that. I do a trend analysis in the highest time frame that I can afford the risk. And let me say that again. I'll do my trend analysis in the highest time frame that I can afford my risk. Now, depending on the type of trader I am, if I'm a day trader or a position trader or a wealth trader, that time frame risk trend analysis could be quite different. So what I would do is, if you had conflicting scenarios in lower time frames versus higher time frames, well, I think, Andrew, you can know what I'm going to say to you. I'm going to look at the higher time frame to give me that analysis. That's the one I'm going to rely on. And I'm not going to worry about what is going on in the lower time frame. Now, what I might do is look for an oversold scenario in a lower time frame, an oversold in an uptrend, which we could see that our RSI and stochastics have now turned to a positive convergence, have turned up, right? A contra signal, that would be something that I would be interested in looking at, right? But I'm not going to use the lower time frame to initiate a position. I might use it to confirm what I'm seeing in the higher time frame, okay? So again, using higher time frame analysis to give us greater confidence of trend analysis. All right, so great question there, Andrew. We've talked about this before in the past. Okay, Gene, what did you have?
Well, no, a lot of people are asking where they can go to find some of the webinars that you've done in the past. You mentioned your candlestick webinar. You also did one really focusing on stochastics and RSI in regards to the cheat sheet, I believe.
Yes.
That would have been use the trader's cheat sheet to identify support and resistance. So yeah, John has our webinar archive page up. They are grouped by category over here. So you might have to kind of read through the screen and look for the specific thing that you're looking for. John, can you go to the education page where there's the search box at the top? Tools and then just site education. This page may also be of interest. You can type in RSI, for instance, or candles. It will tell you things that we have already posted out there. Some of them are videos. John's showing you his candlestick chart video or webinar. And others, there may be text documents, web pages that you can also view over there. Okay, thanks, John.
Cool. All right, since we're at this part of
your webinar page, let's talk about next week.
Next week, exactly. So next week, we're going to look at top stock picks. This is one of our premier pages. And let me just show you where that is. All right, top stock pages. And what is this? Is a proprietary system that looks at multiple of technical analysis to give you some potential trades, either buying opportunities or selling opportunities, depending on what you want to look for. And there's a lot of nuances inside of this page. It is a premium page. What we're going to look at is that right now, we got to admit that it might be difficult to find stocks that are going to appreciate because we're at record all-time high. So what we're going to do is we're going to take a little bit of a different spin on this one. We're going to look at what indicators are giving us our top stock picks, and maybe we'll look at only a handful of indicators that will give us a better result because of the fact that we are at such extreme highs across the board, right? In other words, what we're going to look for is markets or stocks that have already made these corrections, one that we just saw on Monday, but other markets that have already corrected. For instance, a lot of energy stocks have corrected, 20% from their most recent highs, and look for certain indicators that are going to give us some more positive or greater probabilities for success. All right, so that one should be fun. I think you guys will enjoy that. I hope that you enjoyed today's section. Again, Gene, thanks for making it for a great session. I hope you feel better. Until next week, I want to wish everyone the best of health, safe travels, and the good of all trading.
Thanks again, everybody. We hope to see you next week, and thank you for using Barchart.com. Bye now.